Welcome back to Open Line, talking taxes and money and free advice from Dr. Friday, our tax specialist. Lots of people calling. Let's go to Thomas. Hello, Thomas.
Yes, thank you, sir. Thanks for taking my call again. You answered my first question.
Oh, good. Well, go ahead.
And I've got a second question completely different. I finally signed up for Obamacare, or whatever it's called, this past year, and I received a $450 a month tax credit.
Okay.
How will that affect my taxes for 2016? I was told that if my income didn't change, that it wouldn't affect it any. I was just wondering if you could give me any information on that. Thank you.
No, and that, again, that's a great question, because there's a lot of people listening. Two things, one of the changes we have this year and last year was really rough. You are receiving forms called 1095s, B's, C's, A's. It may have different letters behind it, but it's very important that you bring that, or you use that when you do your tax preparation, especially if you're in the marketplace, because on those it's saying how much did you pay and how much did they pay on your behalf, and what was the total amount paid for your insurance. And as Thomas pointed out, if you told them you're making $20,000 and you only made $20,000, there is no problems with the whole situation. The problem is some people, especially a lot of my clients that are self-employed, their income is like a roller coaster. So last year they may make 20, this year they may make 30 or 40. And so you may end up having to pay back on your tax return some of the money that they advanced you on your health insurance. So my suggestion is one of two. One, make sure you don't forget, make sure you file your 1095 information so that IRS doesn't send you a sweet little love letter saying, hey, we can't process your return because you forgot to tell us about your insurance. Second, if your income is going up or down, that means you have to track it more than once a year. But especially if it's going up, you want to contact them earlier versus later so that you can make a new adjustment to your health care so you're not having to pay that money back later.
Okay, yeah, that is a big issue.
That's a big issue, because a lot of people are getting $300, $400, $500 a month as the government is paying on their behalf, and then the next year their wife got a part-time job and now they have more money. So when they do their taxes, they're finding out that they're owing $200 or $300 or $400, and that's a lot of money.
Absolutely. Let's go to Carrie. Hello, Carrie.
Good afternoon. My question, Dr. Friday. Of course, I have a 1095A because I have the Affordable Care.
Good man.
I had a daughter who was in college. In 2015, over halfway through the year, she got married. So I've got two 1095As, and of course, part of the year
she was on it, the other part she wasn't.
And then the latter part of the year is just me. So, of course, she's married, has income. So how do I report those two different? Does all of it go towards me? Does any of it have to go towards her tax return?
Well, you're going to put in both 1095Bs or A's in your tax software, however you're doing it, and you're going to on there and ask who's covered by this. So the first 6 months it's going to be you and her, the second 6 months just you, and that way they have her Social Security number and her name to apply it to her when it comes to doing, that situation, and when she files her taxes, because that's the only proof she has that she had insurance for the first 6 months or whatever months that was. So you need to make sure you list her on there, that she was yours, and you want to file both of them, and you got new account numbers on both of those, so they can tie those in there. So you will actually put her on that particular form. You don't need her on your tax return, but on that form you will put her.
Yeah, I can't have her on my tax return because she's not dependent.
Exactly. But a lot of people have children on their insurance forms up to the age of 26 that are not dependent. So that's important, is to list those dependents though on the insurance information, because that's what the IRS is counting on to be able to go and tie to other people's Social Security numbers.
Carrie, thank you very much. Let's go to Linda. Hello, Linda.
Hello.
Hey.
Yes, I have two questions. One question is, I'm 67, my husband's 66. We're both retired. Are you still there?
Yes, ma'am.
Yes.
Okay. And we're both retired. He has a 401k rolled over into an IRA in the bank.
Okay.
I have a 401k rolled over in the bank. and we have not used any of that interest.
Okay.
Do I turn that interest in this year? We've not used any of the money at all.
No.
So
If you
nothing
haven't,
else. So do I turn that interest in this year that it grew or not?
no, ma'am. That's going to stay safe and sound in your deferred income account or in the IRAs until you draw or you guys hit 70 and a half, and you'll have to take what's called required minimum distributions. At that time, you'll start reporting a portion of that. The government wants their share of the growth, so you'll report it then. But other than that, no, sweetheart, you do not report anything until you take a draw from that account.
Okay. All right. Now, does that answer your question, Linda?
Yes, the second question is, my mother-in-law passed away about 5 years ago.
Oh, okay.
A tax lady told us that we did not file taxes for her if she did not make over $10,000 that year, and she didn't make $10,000 that year. So, was that right? She passed away. She did not make over $10,000 that year.
Okay, so the answer is it's correct that she's not liable, but many times some of these people have Medicare that's helping or Medicaid that's helping out when you're a senior and paying for things. You do want to file a final tax return, and you do want to get a waiver from Medicaid or Medicare, depending, it's Medicaid, I believe, from them to make sure that there is going to be nothing coming back at you. So theoretically, her concept is correct, but if somebody passes away, always file, even if it's a zero tax return, on that final year. It closes out their Social Security number. The government then has it filed, because how are they going to find out if that person's deceased if you don't tell them on a tax return? It's not like it's something that's kind of reported to them otherwise. So you really do just want to kind of close that door.
Okay. All right. Thank you very much for those questions. Let's go to Sophia. Hello, Sophia.
Sophia.
Hello, how you
Fine.
I had a question about something similar to the call a few minutes ago. I got a traditional RA, and I was just wondering, see, I'm 70 and I'm 72, and I've started taking the required amount out. But at the end of the year, I filed the taxes on it, and they give me the taxes they took out right back to me. And I was just wondering, do I have to still file income tax form on it?
That's great. Sophia, I'm going to make a wild guess that, can you give me a ballpark of what you're usually drawing from the RMDs or the required minimum distributions? Just a ballpark. You don't have to give me.
About the IRA, the money I take out?
Yes, ma'am.
$5,250.
Okay, and are you living off Social Security otherwise?
Yeah.
Okay, so you are not required. At first, when you call and you have your RMDs, make sure they do not withhold any withholding taxes. You are not required to pay any tax.
Don't let them take in out.
Right. You may, depending on your situation, you might want to consult with someone, because you could actually take out more money, convert it into a Roth every year, tax-free.
Yeah, okay.
And if you don't need the money, keep in mind that whoever's going to inherit that money from you will inherit it tax-free. So every dollar you can move over there will save taxes, not for just you, but for the next generation, if that's something you want to consider. I'm not a financial advisor or planner. I'm not going to tell you, but I'm just saying there are some wonderful ways of getting the money out of that without having to pay taxes. And anytime we don't have to pay taxes, I'm excited.
And I'm saying they give me the taxes back when I file the income tax.
You do not need to file income taxes, Sophie.
Don't let them take taxes out on it.
And you don't need to file, period. Don't let them take your money. It's your money, and you don't need to actually file if you continue doing what you're doing right now.
Just don't let them take the taxes out on them. That's what I was trying to say.
You are 100% correct. Do not, when you do when you call them or whatever you fill out every year, make sure they take out zero withholding.
All right, very good. Thank you, Sophia. Thank you.
Good question.
Let's go to Lee. Hello, Lee.
Hello, I have a question. If you're single and you sell your property, your residential property, for $500,000, you're only, my understanding what you said was you're at $250,000, you would not have to claim the taxes on it. What would happen to that other $250,000? Could you reinvest into another home and not have to pay any kind of tax on it that way?
Well, let me clarify one thing. I'm talking above what your original investment was. So if you sold the home for a profit, of $500,000, there is no reinvestment. You're going to pay capital gains tax. It's bottom line. There's no way of moving it over. There's no 1030.
Even if it's your residential home?
Right. This is the new law. Before, it used to be where you could do a reinvestment within 2 years after you sold it. They changed the law to giving us this exclusion. But so if you paid $200,000 and you sold it for $500,000, you'd only have to pay tax on $50,000. But if you sell it for $500,000 above what you originally paid for the home, then yes, you will be paying some capital gains tax on that, and you might want to make sure you talk to a tax person before you do something like that.
And you do not even get credit like the $250,000 where you could sell your home for nothing, like it used to be.
Correct. There's no reinvestment program. So the bottom line is, it's your primary home. Whatever you originally paid for it, you sell it for $250 more or $500 more than that, then you will pay tax on everything above that.
Could you? And maybe you should just ask this. Could you buy another property?
Not for your primary residence.
Okay,
if you're
that's not
doing
a rental property. Yeah, okay.
There's called 1031 exchanges where you can do that. But on residential, no.
All right, good. Good question, Lee. Thank you. Well, let's keep going through here. Let's go to Ellen. Hello, Ellen.
Yes.
Go right ahead.
I have a couple of questions.
Sure.
One is, I am not 59 and a half, which I understand makes a great deal of difference.
It is one of our golden numbers. Yes, ma'am.
I suffered some severe injuries and am on a disability, which is not SSI, but disability
from an employer
or over the years. So I would like to know, in addition to that, if I were to be released to go back to work, how much money can I make? Is there a limit? And also, someone has approached me about taking in a foster child, and I heard your comments earlier on dependents, so I'm not really sure how that works.
Okay, so she's saying that she's not on the disability through Social Security, but she's through an insurance disability in which she may have paid into through her job, which means that she actually doesn't pay tax on that, possibly. And if the employer provided it, she will be paying income tax on that. Either way, I guess the one question was, with the child, foster care money will not be taxable, but as far as claiming a foster child on your tax return, you don't have earned income. Therefore, there's still no credits for you, because even though you pay tax on disability, if it's from your employer reimbursement situation and you may still pay income tax, it's not earned. I'm not sure the first question. I honestly don't know if there's any limitations to earnings, like with disability, with Social Security disabilities. Many times there are earning that you can only earn so much before that they'll start cutting you back. Honestly, I don't know enough about this particular policy to know what your situation is to tell her if there's a cutoff or not. Sorry.
Okay. All right. Thank you. Let's go to Charlton. Charlton, hello.
That's a cute name.
Yeah, that is a good name. Are you there, Charlton?
Listen to your name.
Oops.
Charlton?
Hello?
Hello, go right ahead.
Yes, good afternoon. Yes, my question is that I get Social Security disability, and my wife, she made $356 last year, and last year I made $18,000 in disability insurance. My question is, because of that amount, would I have to file a tax return?
Okay, well, was this on a W-2, the $350?
Yes. Oh, no, I'm sorry, it wasn't.
Okay.
Okay. Is that?
I think the wife's helping.
I think so.
Well, theoretically, if you make more than $500 in cash from cleaning or doing some other service, whatever, then you need to file a Schedule C and pay taxes. It will not make his disability taxable. There would be nothing, but there would be some self-employment tax that would come into play after that. So there could be a small amount of tax. most likely very little, if at all. So, and if this person was self-employed, they may have had a few expenses they could have offset to zero that out pretty much, right? So I'm just going to say, you know, theoretically, you might need to consult with a person if this was a 1099, but 1099s are only issue for people that make $600 or more. So I'm not too sure what form we have on this. So if it's not a W-2, I don't think you received a 1099, but by law, anything over 500, you're supposed to pay taxes on. So she's under that. So I'm thinking they would not have to file taxes.
Good. That would be good news.
That would be good news.
Okay. All right, we have to take a break. There's several people on the line. We will get to your calls, I promise. Couple lines open if you want to call, 615-737-PLUS, 615-737-7587. Take a break. Be back right after this.